This week, the market decided artificial intelligence was over. Chip stocks got destroyed. Korea's market had its worst month since 1997. Every headline said the same thing. The bubble finally popped. And the whole argument was about chips. Who makes them? Who buys them? Whether anyone actually needs this many. Here's the thing. While everyone was fighting about silicon, the real constraint quietly moved somewhere else entirely. It's not chips. It hasn't been chips for a while. And once you see where it went, this entire week reads differently. So let's do the crash first, because you need it to understand the rest. A fund called Situational Awareness was worth about $45 billion at its peak. It was running roughly 4 times leverage, which means for every dollar it actually had, it controlled about $4 of stock. That works beautifully on the way up. On the way down, it's a countdown. The chip complex wobbled. The margin calls came in from Goldman Sachs, JP Morgan, and Bank of America, and the fund sold its entire public stock portfolio to Citadel in one go. Its assets went from $45 billion to around 10. 6 days before that happened, its founder had written to investors calling the sell-off one of the most attractive opportunities since early 2025 and asked for more money. Underneath that, 3 times levered funds that ordinary retail investors were using to bet on chip stocks had their assets cut by about 2/3. So that's your crash. Not a verdict on artificial intelligence, a forced seller and a thin bid. Except, and this is the part that breaks the story, in the exact same week the market was pricing the end of artificial intelligence, Amazon reported its cloud business growing 37% to $42.2 billion in a single quarter. And then it raised its capital spending plan for this year to about $220 billion. Not cut, raised. So the prices said demand was over, and the actual customers said the opposite, out loud, with money. The demand never confessed. Which leaves a much more interesting question. If demand isn't the limit and chips aren't the limit, then what is? Here's what almost nobody prices in. A data center is not really a building full of computers. It's a building full of computers plus an enormous continuous supply of electricity. A single large artificial intelligence campus can draw as much power as a small city. And you cannot ship electricity in a box. You need generation. You need transmission. You need a substation and a transformer the size of a house. And permission from a grid operator and a queue position. All of that is physical, and all of it is slow. Chips are a supply chain. You can build another fab, run another shift, buy your way to the front of the line if you're big enough. Power is a construction schedule. Nobody gets to skip it. And right now, that schedule has completely detached from what the artificial intelligence industry is promising. So, look at this. General Electric Vernova is one of the largest gas turbine makers on Earth. Turbines are how you add serious electricity fast, and they are exactly what data center developers are reaching for right now. At the end of the second quarter, its order backlog hit 116 gigawatts. 1 quarter earlier, it was 100. Now here's the other number. The company's annual production capacity is being raised to about 20 gigawatts a year. It reaches 24 gigawatts in 2028, and it's targeting 30 by 2030. So 116 gigawatts of orders against roughly 20 gigawatts a year of ability to build them. That's about a 6-year queue at full rate. And the company's own chief executive expects turbine reservations to be sold out all the way through 2030 by the end of this year. Read that again. The machines that make the electricity are sold out for the rest of the decade. And turbines are only half of it. Even if you have the power, you still have to connect it. That's what a transformer does, and high-capacity transformers have gone from lead times of roughly 12 months back in 2020 and 2021 to 48 to 60 months today. 4 to 5 years. For a piece of equipment. Not to design it, not to permit it. To receive it. And this isn't theoretical. There are 2 data centers in Silicon Valley right now that are finished. Built, standing there. And they cannot switch on because the transformers needed to energize them do not exist yet. That is the most honest image of this entire trade. A completed artificial intelligence facility, sitting dark, waiting on a piece of steel and copper with a 5-year lead time. You can raise $220 billion of capital spending in an afternoon, You cannot raise a transformer. Now the kicker, and this is where the scale actually lands. The Texas grid operator runs the interconnection queue for one of the biggest power markets in America. At the end of 2024, the large load requests sitting in that queue added up to 63 gigawatts. During 2025, it went to more than 230, nearly 4 times in 1 year. More than 70% of those requests came from data center developers. And in the first quarter of this year alone, another 198 gigawatts applied. Meanwhile, Morgan Stanley models the United States running about 44 gigawatts short of the power its data centers need through 2028, up to a 20% shortfall. So the demand for electricity is arriving roughly 4 times faster than the system that delivers it can even process the paperwork, let alone pour the concrete. Okay, here's the honest part, because a thesis without a way to lose is just a sales pitch. 3 ways this is wrong. 1, it's already partly priced. Power and grid equipment names have re-rated hard. The constraint being real does not mean the stocks are cheap, and buying a correct thesis at the wrong price is still how people lose money. 2, financing. The 30-year Treasury yield just hit a 19-year high, above 5.2%. Everything in this story is capital-intensive and long-dated. Higher long rates make every builder more expensive to finance, and that pressure lands on exactly the companies solving the bottleneck. 3, the shortfall might get solved off-grid. Developers are already going around the queue with on-site generation, fuel cells, storage, and their own turbines. Morgan Stanley's own framing is delays rather than dead ends. If that works better than expected, this constraint loosens quietly and the whole picture softens. So here's the read. The market spent this week arguing about whether artificial intelligence demand is real, and it asked the wrong question. Demand is not the variable. Amazon's cloud growing 37% while it raises spending to $220 billion settles that for now. The variable is delivery, and delivery is now governed by turbine slots sold out to 2030, transformers with 5-year lead times, and an interconnection queue that quadrupled in 12 months. Which means 2 things. First, when you hear that artificial intelligence capital spending is going up again, the right follow-up question is not how many chips. It's, where is the power coming from? And when does it energize? Second, the crash we just watched was a leverage event sitting on top of a demand story that is still accelerating into a physical wall. Those are completely different risks, and this week they got collapsed into one headline. So here's my call, and here's how you can hold me to it. Power, not silicon, is the binding constraint through 2028. I'm wrong if General Electric Vernova's turbine backlog drops below 100 gigawatts, or if the company publicly says its reservations are not sold out through 2030 before the middle of 2027. That's the falsifier. Watch the order book, not the narrative. One last thing to sit with. Every model you use, every chatbot, every agent, every one of those $220 billion of spending is downstream of a substation that takes 4 years to build. So if the demand is real, and the power isn't there, what exactly does the money buy? Tell me what you think in the comments, because I genuinely don't think this one is settled. Today's full daily brief covers the rest of the tape, and it's linked below. I'm Frankie. The asymmetric signal. One contrarian read a day. Subscribe. Research and education only, never investment advice.